Welcome to our channel, SNK and Company. The Minister of Finance, Nirmala Sitharaman, presented the Union Budget for the financial year 2026 to 2027 on February 1, 2026 at 11 a.m. before Parliament. Along with the budget, the Finance Bill 2026 was introduced, proposing several significant amendments in the goods and services tax laws. These amendments, once passed by Parliament and after receiving the assent of the Honourable President of India, will be brought into force through appropriate notifications. Considering that GST is a dual levy requiring concurrent amendments by both the central and state governments in their respective GST laws, the operationalization of these provisions may take time and is expected to be effective by around October 2026. From the perspective of SNK and Company, these proposed amendments reflect a pragmatic approach by the government towards addressing long-standing industry concerns and rationalizing certain rigid provisions that were not aligned with commercial realities. One of the most welcome amendments is the proposed change in Section 15(3)(b) of the CGST Act relating to post-sale discounts. Presently, deduction of post-supply discounts from the value of supply is permitted only if such discount is established in terms of an agreement entered into at or before the time of supply and is specifically linked to relevant invoices. This requirement has created substantial compliance hardship and litigation, as commercial transactions do not always operate strictly on predetermined written agreements. Trade practices frequently involve performance-based incentives, turnover discounts, or market-driven adjustments that may arise after the supply is affected. The proposed amendment provides that where a credit note has been issued by the supplier and the recipient has reversed the input tax credit attributable to such discount in accordance with Section 34, the discount shall be permissible as a deduction from value without the need for prior agreement or invoice-level linkage. This aligns the GST framework with commercial practicality and reduces avoidable disputes. From SNK and Company's advisory standpoint, this amendment significantly enhances flexibility in pricing structures and incentive schemes, while maintaining tax neutrality through mandatory ITC reversal by the recipient. In continuation of this rationalization, Section 34(1) of the CGST Act is proposed to be amended to explicitly allow issuance of credit notes where a discount referred to in Section 15(3)(b) is given. Earlier, the section primarily contemplated situations where the taxable value or tax charged exceeded the actual amount payable, or where goods or services were found deficient. The insertion of specific reference to post-sale discounts removes interpretational ambiguity and provides a clear statutory backing for issuance of credit notes for commercial reasons. This amendment reinforces the government's intention to recognize business realities and to reduce unnecessary litigation on technical grounds. Another major relief proposed in the Finance Bill 2026 pertains to refunds in cases of inverted duty structure. Currently, Section 54(6) of the CGST Act permits provisional refund of 90% only in cases of zero-rated supplies made without payment of IGST. Taxpayers facing inverted duty structure situations, where input tax rate exceeds output tax rate, were not eligible for similar provisional relief and were compelled to wait for final refund sanction. The proposed insertion of enabling words to cover unutilized input tax credit under Section 54(3) First Proviso Clause 2 extends the benefit of 90% provisional refund to inverted duty structure cases as well. From a cash flow perspective, this is a substantial relief for manufacturers and traders operating in sectors such as textiles, fertilizers, and certain engineering goods where inversion is common. SNK and Company views this amendment as a progressive step that will ease working capital pressure and enhance liquidity for affected businesses. In another noteworthy change, Section 54(14) of the CGST Act, which currently restricts refund where the amount is less than 1,000 rupees, is proposed to be amended to carve out an exception for exports made with payment of IGST. Accordingly, refund of IGST paid on exported goods shall be granted even if the amount involved is less than Rs 1,000. This measure, though seemingly minor in monetary terms, carries significant practical importance. Small exporters, especially those exporting through courier, post, or e-commerce platforms, often deal with low-value consignments. Denial of refund merely due to the threshold created disproportionate hardship. By removing this restriction in export cases, the government has extended tangible support to micro and small exporters and strengthened the export ecosystem. The Finance Bill 2026 also addresses the issue of conflicting advance rulings across different states. It has been observed that in certain cases, appellate authorities for advance ruling of different states or union territories have delivered divergent rulings on identical questions of law. Section 101A of the GST Act provides for appeal before the National Appellate Authority for Advance Ruling in cases of conflicting rulings. However, such authority has not yet been constituted. The proposed insertion of Section 101A(1)(a) empowers the government, on the recommendation of the GST Council, to notify and authorize any existing authority, including a tribunal, to hear such appeals until the National Appellate Authority is formally constituted. It is anticipated that the principal bench of the GST Appellate Tribunal may be entrusted with this responsibility. This provision is proposed to be effective from April 1, 2026. From SNK and Company's perspective, this amendment is crucial for ensuring uniformity and certainty in tax positions across the country, and for strengthening the credibility of the advance ruling mechanism. Perhaps one of the most significant structural changes proposed is the omission of Section 13(8)(b) of the IGST Act relating to intermediary services in cross-border transactions. Under the existing provision, the place of supply in case of intermediary services was deemed to be the location of the supplier, even if the recipient was located outside India. This resulted in a paradoxical situation where an Indian intermediary providing services to a foreign principal was required to pay IGST despite earning foreign exchange, whereas services provided by a foreign intermediary to an Indian principal did not attract similar tax in India. The proposed omission of this clause will shift the determination of place of supply to the general rule under Section 13(2), that is, the location of the recipient. Consequently, intermediary services provided by Indian agents to foreign principals would qualify as export of services, subject to fulfillment of other conditions. This long-debated anomaly persisting since inception of GST is finally proposed to be rectified. SNK and Company considers this amendment a major policy correction that restores parity and promotes India's services sector competitiveness in global markets. In conclusion, the amendments proposed in the Finance Bill 2026 reflect a constructive and responsive approach by the government towards addressing practical challenges faced by trade and industry. The changes relating to post-sale discounts, refund mechanisms, advance rulings, and intermediary services demonstrate a clear intent to reduce litigation, improve liquidity, and enhance certainty in tax administration.